Imagine this in 2026, a billionaire pays an effective tax rate of 3.4% on hundreds of million in income. You pay 25 to 35% on a fraction of that. Same country, same tax laws, same government. How is that possible? It is not loopholes, it is not cheating, it is not offshore accounts hidden in Panama. It is completely legal, public, and built into the system most people never learn how to use. Today, we are exposing exactly how rich people legally pay far less tax than the average person, and more importantly, which of those same strategies are available to regular people in 2026. Even if you earn a normal salary, no illegal tricks, no shady advisor, no citizenship investment schemes, just the real moves the wealthy actually use every day. If you have ever looked at your tax bill and thought, this can't be right, stay until the end. I'm going to give you a simple 2026 checklist of 5 legal moves you can start this year that could cut your effective rate or save you thousands without changing your lifestyle. Let's begin. The biggest myth is that rich people pay less tax because they hide money or exploit secret loopholes. That's Hollywood. In reality, the wealthiest individuals and families use the exact same tax code as everyone else. They just read the fine print, plan decades ahead, and structure everything around three core principles. Principle 1: earn income that is taxed at the lowest possible rate or not at all. Principle 2: defer taxes as long as possible so money compound tax free. Principle 3: convert ordinary income into long-term capital gains or qualified dividends whenever possible. Let's look at the real tools they use. First and most powerful, borrow against assets instead of selling them. When a billionaire needs cash for a house, yacht, another businesses, they almost never sell stock. Selling triggers capital gains tax, sometimes 20% or more plus estate tax. Instead, they take low interest loans against their portfolio. Interest rates in 2026 for securities backed lines are often 5 to 8%. Their investments keep growing at 10% or more historically, so they come out ahead. The loan interest is often deductible if structured correctly, and they never trigger the tax event. They die with appreciated assets and heirs get a step up in biases, meaning the gains are never taxed at all. You can copy a version of this today if you own a home with equity. A Hello to at 6 to 9% can fund investments or emergencies. If you have a taxable brokerage, many platforms offer portfolio lines of credit. Borrow instead of sell when possible. Second, maximize tax advantaged accounts and use them strategically. The rich max every retirement vehicle, 401k, SEP, IRA, backdoor Roth if their plan allows. They also use HSAs as stealth retirement accounts, triple tax free if used for medical later in life. In 2026, contribution limits are still generous relative to average incomes, but the real edge is asset location. They put high growth assets in Roth accounts for the tax free withdrawals, bonds, and dividend pairs in traditional accounts to defer taxes, and tax efficient index funds in taxable accounts. Regular people can do 90% of this. Open a Roth IRA if eligible, do backdoor Roth if over income limits, max the employer match, it's free money. Use an HSA if you have a high deductible health plan. Third, harvest tax losses and manage gains. Direct indexes, robo-advisors, and manual tax loss harvesting are standard for anyone with $50,000 or more in taxable accounts. Sell losers, buy similar assets, offset gains are up to $3,000 of ordinary income. Carry forward unlimited losses. In volatile years like 2025, many people offset tens of thousands in gains. You can do this manually in Fidelity, Schwab, or Vanguard, or use automated services like Wealthfront or Fidelity Go. It is a free or low cost and adds 1 to 2% after tax return for money. Fourth, use business structures and deductions. Anyone with side income can form an LLC or S corp and deduct legitimate expenses, home office, internet, phone, mileage, equipment. The rich take this to another level with family limited partnerships, charitable trusts, donor advised funds, and opportunity zone investments that defer or eliminate gains. You don't need millions if you freelance, drive Uber, sell on ETCY, or have any side hustle. Track every expense and deduct it. Consider an S corp if self-employment income is high enough to save on self-employment tax. Fifth, charitable giving done smartly. Instead of cash, donate appreciated stock or real estate. You get the full fair market value deduction, avoid capital gains tax, reduce taxable income. Donor advised funds let you bunch donations for bigger atomized deductions in high income years. In 2026, bunching is even more powerful if tax bracket shifts or you have a big income year. Sixth, life insurance and private placements policies for ultra high net worth. These are advanced, but the concept is simple. Cash value life insurance grows tax deferred, loans are tax free, and death benefit passes tax free. Not for everyone, but a legal way to shelter large amounts. For most people, this is overkill. Stick to the first five. Quick 2026 checklist you can run today. 1. Do you have low interest debt against appreciating assets instead of selling? 2. Are you maxing every tax advantaged accounts and use Roth when it makes sense? Number 3. Are you tax loss harvesting in taxable accounts at least once a year? Number 4. If you have side income, are you deducting every legitimate expense? Number 5. Are you bunching charitable donations or donating appreciated assets? Rich don't break the rules, they master them. The same tax code that seems unfair is full of incentives for long term thinking, investing, and planning. You don't need to be a millionaire to use 90% of these moves. Start with one this year, open the right account, harvest loss, deduct side hustle expenses, and watch the savings compound. If this opened your eyes to how the manage is really played, hit like, subscribe, and comment. Which strategy are you trying first in 2026? Borrowing against assets, better tax law harvesting, or something else? I read everyone. Thanks for watching. Stop paying more tax than you have to legally. See you next time.